We seem to be firing on all cylinders. But is the banking sector and the financial sector keeping up? I'm speaking today to a very special guest. I think I wouldn't be exaggerating if I said this is a legendary banker and expert of the financial sector, currently also chairman of NABFID. So the right person to speak to on India's infra push and much more. Mr. KV Kamath, thank you so much for speaking with us today on NDTV Profit.
Thank you, Tamanna.
Great to have you here on the show. Let me begin first by getting your take on what we saw presented in the interim budget from the point of view of a position of let's keep tight on the fiscal deficit while spending wisely. Capex has come down in terms of quantum and pace, but still significant on a higher base. Do you think that's setting us up for the next leg of growth?
Yeah, indeed. I think one needs to compliment the Honorable Finance Minister on charting a path forward, while at the same time keeping deficit under control. And it's a remarkable tightening of the deficit that we are seeing. So it's again, in that context, a remarkable balancing act. And I think it's the government will deliver on this.
Yeah. In terms of the infra push, that's been the big story in India over the last couple of years. It's been fueling the economy, the markets as well, of course, as a secondary idea. Do you think that a reduction of capex, and if we want to go below 4.5% on fiscal deficit in FY26, brings in a bit of constraint?
Yeah, I think it's, we need to look at it in context. There will be certain areas of infrastructure which may not need the government to invest going forward. You will see more of private sector investment happening. Take, for example, the entire green side of power. I think that's where the private sector is firing on all cylinders, whether it is solar or green energy, hydrogen and so on. It's all driven by private sector primarily. There are government players, of course, but there is no budgetary support coming up. At the other end, almost everything that's happening in the telecommunication sector is happening at the private end. Ports is also happening at the private, whether airports, seaports, and so on. So large pieces of infrastructure, which earlier needed handholding by the government, are now getting in a way to be done by the private sector, or where it's done by the government. Take the case of highways. It's being financed through either cash that the NHI is throwing up to its SPVs, or through the InvITs that they have created and are now what I would call a perpetual cycle engine. They can fund for a long time without access to budgetary support. So a large part of expenditure which otherwise conventionally we took as coming out of the budget is now being financed. So what remains, as I say, is, for example, the rail sector. For some time, it will have to come out of central. But otherwise, most funding, we roll on to the next 25 years, will be funded by the cash that is thrown up or by the private sector.
Just one comment from you on the growth targets that we have. We're expected to grow a tad over 7% at a time when the rest of the world is recovering, yes, but at a much slower pace. You also have a sort of a goal to turn into a developed nation by 2047. Just your comments on these 2 points and whether we are well on track at the current pace of growth.
Yeah, I certainly think that we are well on track. In fact, I would believe that we probably will grow a little higher than 7%. Time will tell. But I'll say why I believe we'll grow higher than 7%. The reason is that the full benefits of the digital economy, I believe, have not been factored into the 7% number. The 7% assumes the current level of digital contribution from the digital economy. My view is looking at other economies. Digital in the next 4 to 5 years should add another 20-25% to the growth rate that you already have. So if I take 7 as the base case, then you have another 25% to that. So you're talking of probably somewhere 8.5 to 9 that we will be pleasantly surprised when we add the digital piece to the core growth that we are seeing.
Okay, let me come to one big talking point right now, and it's what's happening with India's private banks. We are in results seasons, we're speaking with a lot of bankers, and one constant refrain is slower deposit growth, higher cost of funds. If you were running a private bank today with all the vast experience you've had, what would be your strategy and what do you think the issue is?
See, there is one more element which nobody is mentioning, and that is the cost. So I would concentrate on costs.
Cost of funds, you mean?
No, cost of operation.
Oh, okay.
So I would say that if my cost to income ratio is nearing 40% or around 40%, plus minus, what does it take to bring it down to 20%? With technology that is available today, I would say that that's my target, the next target. And then nobody will worry about NIMs dropping by 5 basis points or 10 basis points. It's going to be not material. So to me, the big ticket item that is on the table, which banks I'm sure will grab in as they go along, is the cost to income ratio and bring it down so that they remain competitive, get the yields that they want and get the returns that they want on equity. Having said that, as of today, ROEs of banks are at level which in my career I have not seen. See, there are a whole clutch of banks where ROE is above 15%. So these were aspirational ROEs. We used to work with 12.5% was good for a bank. So I would think that there are a lot of good things that are happening. ROA, for example, again, a lot of clutch of banks above 1.75 ROA. So to me, there is a whole lot of positives. And then you've got this big ticket item where you can cut costs in terms of using current technology, the operating cost for your bank. You could do well. In terms of deposit growth, yes, it has moderated. And this, I think, needs to be factored into the base case, that it's not going to suddenly reverse as we go along, because there are other instruments that have come up, particularly through the capital market side, which your current customers will use, particularly the corporate customers. So probably it's a given that your key customers for a bank are going to be the retail customers that you have, with the newer products, newer ways to deliver them and so on. So that's where I think you will see growth happening. And of course, nobody is going to go away from banks entirely. But there will be now a healthy balance between growth in bank deposits and growth in savings that come through the capital market. So example, mutual funds or the like.
So to understand this in another way, can we say that savers are now preferring to put in more of their bucket, say, into their SIP? You're seeing fantastic SIP figures, or into the capital markets, instead of letting it languish in a savings account or even a fixed deposit. And this is a reality that banks will have to live with.
Yeah, absolutely. And that is happening. So incremental, whatever the saver has got, he has now put it into a SIP. Virtually automatically every month it goes into the SIP that he has got. Now, what sort of a saver is putting this money? I think everybody down up to, let's say, the middle of the pyramid or slightly below that. But my assessment is that it is not going to be long before the person below that level, probably towards the bottom of the pyramid, who today has only financial savings that he has are savings account in a bank, is also going to move money into a mutual fund. May not be entirely, he'll keep a base level for operating and other expenses, but he's going to move. So this, everybody will understand that this is the easiest way to save for the long term. And if a 250 rupee SIP is going to be a reality soon, then I think you can see what will happen to those accounts, which are at, I would say, below the, very near the bottom of the pyramid. I think those also will move. So you will have a very competitive and healthy space in terms of the saver seeking better returns and longer term savings. And at the other end, the banks being places where they have trust and they'll keep their money for transactional needs and so on.
So let me come back to that point. Safe to say it's a tough time for bankers. Your corporate borrowers may not need you as much. Balance sheets are healthier. Your depositors also have better options going forward. Your cost of funds seem to be increasing as well. Let me rephrase that question. What would be your strategy right now if you were running a large bank?
I would say that the key growth area for me would be retail, because that customer is still with me. I've got the customer's deposit account, so I know the customer. I have to serve him better. I can sell him a variety of products. I will earn fees to doing that. And I will, for the corporate, working capital, topping up needs, I will provide. So there is a large opportunity out there. But my mix of income will change. It will not necessarily be driven by NIMs alone. The mix of income has to be driven by fees also, because I have a franchise for the deposit franchise covering a large number of customers. I need to see how I could serve it better. And in all this, my key is going to be technology, because it will then also enable me to take out costs. That's how I keep the bank buoyant and ready for the future.
I'm not asking you to make a specific comment on any bank, but recently, because you talked about NIMs, this was the big talk in the markets. And one particular very large private bank got punished quite severely by banking analysts in the stock market. There were concerns. Was it an overreaction?
See, I don't want to comment on any bank, but if I were to look at any particular bank and see whether it has been punished or whatever the market does, I would look at, is there anything fundamentally wrong which you need to punish? I don't see anything fundamentally wrong. So I think a lot of things are probably not understood by the analysts in terms of, or people who then decided to, because there's nothing fundamentally wrong with any bank in India, as I see.
I want to speak a bit about a lot of RBI action recently going on for the last few months. It started with a curtailment of smaller loan takers, small ticket loans. You saw that pan out. Then there was action on AIF investments for banks, and very recently an action on a fintech player, which some in the industry are saying is a punch in the gut for the fintech space. Do you think the RBI is coming down heavy?
No, again, I don't want to talk about any specific case or events which are specific, nor of regulatory action. But I want to talk about it maybe at, slightly from a distance, as it were. Sure. See, I've been in a regulated environment most of my career, at least since I assumed leadership roles in a bank. The regulator in India, to me, is laid out things very clearly, and it is for you to follow what has been put down and operate within the guardrails that have been laid out. Now, this is necessary because ultimately the regulator is overseeing the health of the system and the saver's money. So anything that is then out of line, action needs to be taken. So I would see regulatory action that is taken in the last 6 months or whatever, consistent with that policy. And the key is the trust that the saver has imposed in the regulator, and consequent to which he has put money into an institution. That trust has to be looked after. And I think this is what drives all regulatory action. And I think they are absolutely correct to take steps to make sure that that trust in the system remains strong.
Okay, so broadly, yes, of course, the regulator needs to do his jobs. Regulated entities need to walk the line. But specifically on, what's happening in fintech right now, they're facing a lot of challenges in terms of where they stand in the larger ecosystem. How would you look at that?
Yeah, this is now an issue for the last 2 or 3 years. When I started looking at the growth in fintechs and what they have brought to the table, I need to compliment them for what they have achieved. And what is it that they have achieved? They basically brought a set of platforms which make transactions, a variety of things, of any type of a loan, for example, much easier than what the banks did over time. So these young startups in the span of 2-3 years have built up platforms which the country can be proud of, they can be proud of. The challenge is that they have not figured out how the value that you have created in the platform, how do you create into a revenue model? So that's where the challenge is. Now, there again, you can't do that by stepping out of line. So you have to be in sync in doing.
Do you think there's been a tendency to step out of line?
I don't want to comment that anybody has stepped out of line, but there are at times you can see things being done. You work with somebody, you try to do a few things and so on. So I think the regulator has to be then aware all the time as to what is happening and bring it within the guardrails. And that's what has been happening. Again, this is going on for the last 2 years or so. So almost with every instrument you have seen that happening. A new instrument is created and then the regulator gently, sometimes maybe not so gently, brings you within the guardrails and you operate within those guardrails. So I would think that this is par for any new technology that is coming in and new experimentation that's coming in. But you cannot take away the fact that these entities have brought a lot of value to the table in terms of what they have created. But they now need to see how they can take it forward in terms of value to people who have put money in them and to themselves.
Last comment from you, Mr. Kamath, on the future path for the BFSI and the banking space in India. Do you think it's going to be largely tech-driven, and how can that be used for greater financial inclusion at the end of the day?
I think there is no doubt in my mind it is going to be tech-driven. It is going to be a complete sea change from what we have seen earlier. We are already seeing it. The last 2 years, if you look at it, you see, for example, in the banking context alone, the entire payment space is taken over by new technology. Of course, banks are now using that technology, but who developed it? Third parties basically developed it. As a result, we can proudly say that India has got its own payment platform, which can stack up with the best in the world, and probably is the leading payment platform in the world.
UPI. You're talking about UPI.
The entire, I would say, the rails on which UPI is run can compete with the best in the world. Is a globally scalable model, can be used for global settlements with some tweaking. So there is a whole lot of good that has come out of so to me, that's going to drive things. Thereafter, with almost your entire population of the saving age or the working age now on a device and able to access data and accounts online, that is your target set. That's a new target set. It wasn't just a few years back. And 10, 15 years back, I remember we gave up on reaching rural India because we said technology is not pervaded there. But today you come to a situation where that becomes a given. So I would say the conditions to operate in a technology context are already present. And it is for us, the financial system, to make that happen. Now, that important point that you raised about the bottom of the pyramid. The bottom of the pyramid today has the same access to technology as you and me. Their aspiration is to have that device that we have in our pockets with a slate at one end, basically a device where they can not only talk, but they can see and proceed and transact. Now it's for us as a financial sector players to put an app there, a very simple app there, which gives them control of 2 or 3 things. Basically, you need only your deposits, if you have savings through SIP, your SIP type of savings, and if you have loans, you aggregate all your liabilities at one space. This is all you require, and then you are in control of your life. Again, I repeat, 5-7 years back, 70% or 80% of India was not able to do this. Today they are able to do this. So, I don't know whether you heard of this app called MF Central. The banks had an app. The MF Central is something that SEBI has now worked with CAMS and the 2 registrars, KFIN, to bring out, where at the touch of a button, it's an app, 2 minutes to download or less than that, and basically a 4-digit PIN, and you are into it. You get all your mutual fund at one go, and you can see that number. Now imagine the value this has for the person at the bottom of the pyramid. Now he knows, like I have a bank app where I can see what's in my bank account. I have this app which tells me what I have in my mutual fund account if I have started saving through the mutual fund. And indeed, he has seen others saving through this instrument called SIP. So there is an aspiration that why don't I also save for the long term? And this will accumulate and grow. So I would think that technology is a game changer in terms of reaching the bottom of the pyramid and enabling him or her to manage current needs and saving needs for the real long term through the simplest of financial products. And I think we are pioneers in this. I don't see anywhere in the world that this has been done. So we have already got a lead with over many other, or almost all other, most other countries in the world. And I'm sure this will only progress.
Fantastic. Thank you so much, Mr. Kamath, for speaking with us today.
Thank you.